Welcome to the finale of the Investment Markets July 2023 Investor Webinar. Yesterday, we were transported into a realm of awe-inspiring alternative ESG and global perspectives, accompanied by the invigorating economic update from our esteemed guest speaker. Today, we carefully curated two dynamic perspectives for you: the property and income perspectives and the ETF perspectives. Our first speaker has joined the call. Let's welcome the Chief Investment Officer of Atlas Funds Management, Hugh. The Atlas High Income Property Fund aims to provide investors with income primarily through the acquisition of property securities, with an overlay of an active strategy of selling call options. The Atlas Concentrated Australian Equity Portfolio is a separately managed account constructing a concentrated portfolio of 18 to 30 large-cap securities, a high franked yield, and capital gains tax concessions. If you have the question of what to do with the banks, Hugh has all the answers. Welcome, Hugh.
Yeah, good afternoon. Well, it's been what to do with the banks has been one of the big questions facing institutional investors and retail investors alike. They comprise around about 25% of the ASX 200, pay very high yields, but have also have quite negative sentiment towards them. So they look extremely cheap at the moment. It's been an eventful couple of years for the banks. So with each year seeming bringing another new negative thing, which pundits in the press were going to think that it's going to damage the banks. So 2019, the big story was around neobanks, that they were going to take over the bank's margin, eat their lunch, and and render their whole business model a bit sort of outdated and a bit old. That hasn't proved to happen, with a range of the neobanks handing back their licenses, finding it's just too hard to go up against the strong banking oligopoly, and that's in the last year. 2020, we saw capital raisings from a range of the banks, NAB and Westpac, and indeed both NAB and Westpac stopped dividends. So for income investors, that was pretty bad. First time since 1893 that the banks have stopped paying dividends. Then again in 2021, we had APRA warning the banks about the impact of zero or even negative interest rates, which were forecast at the time, and impact on their systems to handle this sort of very novel level of interest rates, which is unprecedented in 4,000 years of human commerce. It seems quite comical sitting here in 2023 that they were worried about sort of zero interest rates. And then over the last sort of year, we've seen the RBA raise rates 400 basis points from 10 basis points to 4.1 in 12 steps. And that's the steepest rise since the late 80s. And it's still flowing. So currently the market's very negative. There's a lot of negative sentiments towards the banks. And whilst we see sort of bad debts will rise, I think the banks are in a much better situation in 2023 than they were in 2007 to weather the storm. So in terms of looking at the banks themselves, they're becoming increasingly more homogenous, but the way to think about it is Commonwealth Bank and Westpac have heavy weights towards retail banking, and particularly mortgages. Westpac, ANZ and National Australia, much greater weighting to business banks. So historically, that means that Commonwealth Bank and Westpac have lower loan losses. People tend to pay off their mortgages, and higher loan losses for Australia, the ANZ and NAB. Loan losses are important. Bad debts are quite important because they erode capital and impacts the dividends paid to shareholders. Macquarie Bank is increasingly becoming the fifth largest bank, getting very close to the market cap of ANZ at 66 billion. Whilst they're growing in retail banking, they're more a global bank with global activities around the world. So they're not quite as impacted as the same extent as Australia and the Australian banks on a recession. Looking through this slide here, I think this is quite important. So we look at the bad debts over the last sort of 40 years. So with a lot of people, they're thinking that the bad debt cycle that we're facing in 2024 is going to look something similar to the GFC in 2008, 2009, or even the 1991 recession. We take the view that that's far too pessimistic, and the banks are a little bit differently structured. So using a playbook that it's going to be grim like it was during the GFC, or very, very grim like in the early 1990s, That's not quite the way how they are. The banks are in a much stronger financial position in now due to some of their own moves and due to other moves that the APRA have made them do. They're in a much better situation such that there's a reasonable chance they are going to surprise on the upside. Overall, their books are a lot cleaner in 2023 than they were in previous cycles. And that means much more focused on just bread and butter to lending to small businesses and mortgages, less focused on corporate lending, which can be quite result in large debts. Also, a lot of they've cleaned up some of their offshore adventures. So in the previous cycles, we saw ANZ have had heavy exposure into Asia. NAB very famously had very exposure into Northern England and Scotland, which caused a lot of problems for them. So generally they're a lot sort of cleaner and they're much more focused to the Australian market. And we view that that's going to result in much lower bad debts and surprising on the upside in terms of profits over the next year. So looking at what did the banking sector look like in 2007 versus now? So a key thing there is they have a lot more capital now than they did going into the previous cycle. So sitting here in 23, they've had roughly about 12% of capital backing their loans. And that's almost double what they were going to the previous rate tightening cycle in 2007. Whilst a lot of the bank CEOs will claim that that's their own brilliance and how prudent they were, realistically that's just APRA dragging them kicking and screaming to raise more capital to put them in a much more stable position and safer position going into the upcoming any tightening cycle. So for a shareholder, means you're much more safer now. There's more capital backing up those loans than you were looking back sort of 16 years ago. Similarly, the way how banks fund their businesses are a lot more stable now than they were going to the GFC, with much more the loan book being what they're lending being supported by deposits. That's a much more stable source of funding rather than look at 16 years ago where books were primarily funded by the wholesale markets, wholesale markets. That was work. That's also not only is that more expensive, that money can go and it's much less stable. Whereas right now, today, they're in a much more stable position to fund their bad debts, and that also results in sort of higher profit margins. Furthermore, I mean, one of the key things around bad debts and also sort of profits being cut is unemployment. So it's when you think about it, it's not falling house prices that cause bad debts and cause bad debts for the banks. It's the combination of falling house prices and unemployment. Sitting here, we're at 3.5% unemployment, pretty much the lowest in the last sort of 20 or 30 years. And that's very good for the banks and in particular bank shareholders in that people will service their mortgages, perhaps may cut down on some discretionary spend from holidays. So I don't know if you'd want to be owning a lot of Flight Centre and discretionary spend there, but they'll service their mortgage whilst while people still have a job. So they're in a much more stable position there. Also, something which is not really widely thought about it is the Big Four. Their market share has increased quite dramatically, using the previous crisis to expand. So, looking at 16 years ago, a range of their bigger competitors, for example, St George or Bankwest, have now been gobbled up and subsumed into the big banks. That puts them in an extraordinarily strong capital market position. Also, we've seen a range of foreign banks leave Australia, just viewing it sort of too hard. A great example of that is Citibank. They sold their domestic banking franchise late last year to National Australia Bank, viewing the Australian market as just far too hard, with the incumbents having far too much strong sort of power. So that puts them in a very good position. We saw that in February when CBA came out with a fantastic result. The Treasurer talked about how sort of the Australian banks are far too strong and far too powerful and extract too many profits. But then a mere 3 or 4 weeks later, when Silicon Valley Bank failed, we had the Republic Bank was subsumed into JP Morgan. We had that same treasurer congratulating the Australian banking system, how strong and profitable and powerful it is. So it's sort of a feature is whilst they have strong market share, they're also very well capitalized and in a much better situation than European banks or American banking system. Something we'd also like to look at here. This is we do this scorecard every result season, and looked at this is the May scorecard for the banks. So a couple of short months ago, what was really clear all through that this is the banks are extremely profitable. So running at, we saw profits increase in dividends from double digits. The highlight there was sort of Macquarie and CBA, dividends up 20%, earnings per share up quite strongly, net interest margins expanding. That's the money they make over lending loans expanding. Yet at the same time, we're seeing very sort of it's very cheap compared to the rest of the index. So trading a range of the banks, CBA is a bit more expensive than the others. They generally have a much higher return on equity, but trading on a PE of roughly about 10 times currently, and with a sort of a forward yield in that 6 or 7%. And based on our working out, their yield is a lot more sustainable than people think. But if you said the final thing there, it's still a bit negative. The market's still very not sure about the banks, and they're still assuming things are going to fall to bits and be very, very bad for them, very high bad debts. But we don't see, based on looking at where they were in the past, these banks are in a much better situation, and there's a strong reason why they're likely to outperform over there. One of the big things which has been sort of quite puzzling us and puzzling a lot of people who've been calling for massive declines in retail sales and house price falls has been impact of immigration. So after having sort of zero or very little immigration during COVID, that's bounced back very strongly. 2022 was a massive year for net immigration, indeed the highest on record, with 400,000 net migrants coming in. Similarly, 2023 is looking the same, close to 300,000. A lot of these are skilled migrants coming in with lots of cash and wanting to build households. And that's why we're seeing house prices, which, if you'd asked me last September, given the fixed rate mortgage cliff, we would have expected house prices to fall off quite dramatically. Indeed, we've seen house prices rise over the last 4 months. And also retail sales, which you probably expected them to be very, very grim at this stage, with people refinancing mortgages and mortgages going up, they're actually still moving along. And I think the big impact there is this net increase in overseas migration coming into Australia, providing a lift for housing prices, the retail sales, and that's a very good news for bank shareholders, in that with sort of house prices are strong, the economy is looking a lot stronger than expected, and we're likely to see much better sort of financial results than people expect. So pulling all this all together, whilst the market is very negative towards the banks, they're in a much better shape than a lot of people think. And if you look through the cycle, the Australian banking oligopoly has been very effective in maintaining profit margins and maintaining their profits through a range of cycles, and seeing off a lot of issues. We take the view that there's a very cheap sector, and that with the potential to dramatically outperform over the next year as they reduce much lower bad debts than expected, higher profits, because they're in a much stronger position than I think a lot of the market view them at. And using the playbook from other tightening cycles or recessions, from, for example, the GFC or 1991, that's going to give you a far too pessimistic outcome. And we're looking forward to being pleasantly surprised by strong dividends and much better than expected earnings from Australia's banks. To open up to questions.
Thank you, Hugh, for the presentation, and you certainly answer a lot of questions our investors might already have. But I still have some questions for you. In your opinion, what are the differences, if there's any, between the big five? I heard you talk about the Macquarie Bank, the fifth bank, between the big five Australian banks.
Westpac and CBA look rather similar. They're very heavily focused on domestic lending to mortgages, which is historically quite a low loan loss. ANZ is much bigger in New Zealand, which has also been quite a profitable market. They're the largest bank in New Zealand, with National Australia Bank very heavily focused towards business lending. Business lending can be quite profitable sometimes, but it's also a lot more competition. You can do a big loan of 200 million or 300 million rather than $100 million loans, or 200, 300 loans to house. So it can be quite easy to process. But historically, that actually results in higher loan losses, and also lower margin, because you're also competing with big European banks and big sort of Japanese banks American banks for that same business. Macquarie Bank has a smaller share. They're around about 5% of the Australian market in terms of mortgages, but they're a global bank. So whereas the big four Australian banks are increasingly Australian, as I've talked about before, pulling back from overseas adventures, which have generally caused a lot of tears for shareholders. Australian banks do very well at home. They tend to do quite poorly offshore. Macquarie Bank's an exception of that. So they've got a big funds management business with assets under management of close to $800 billion, primarily in infrastructure. Their commodities and global markets business, trading energy globally, has been a very strong sort of source of capital. And then also their Macquarie Capital business, which is investment banking and IPOs. Bit quiet at the moment, but it's generally proved quite sort of profitable throughout the cycle. The big four Australian banks generally are limited by Australian GDP growth, and it's very hard for them to gain market share because their competitors have all roughly got the same cost of capital to lend a mortgage, and they move their prices simultaneously. So yeah, there's fewer differences as compared to they were 10 to 15 years ago. But yeah, so generally what we expect is lower loan losses from the two mortgage banks based in Sydney, so CBA and Westpac, higher loan losses from ANZ and National Australia Bank. But then, as I mentioned a bit earlier, the books are a little bit cleaner than they were going into last things, with a lot of those more contentious developer loans being put onto either private credit funds or second-tier banks.
Well, the last question I have for you is, from an investor perspective, one of the biggest concerns are banks' bad debts and the fixed rate cliff. So what does the future hold for bank bad debts?
Yeah, that's probably the biggest question that's been on all bank investors' minds. We've been quite surprised at the strength of the economy and quite surprised at the lack of bad debts coming through. Bad debts are very important because they impact banks' profitability, reduce their capital, and also ultimately the dividends paid to shareholders. Our view is it's going to be still very, very muted. We're not going to see bad debts spike to 100%, 1% of loans, or even 75%. I think we're still going to be increasing slightly, but nothing like the levels we've seen in previous cycles. And the big factor of that is there less corporate loans on the bank debts, more focus on mortgages, and unemployment's still very low. So in that environment, Australians, it's not like the US where we have non-recourse lending. If I stop paying my mortgage to Westpac, they will come after me to the ends of the earth. I can't just send them back my keys. So Australians historically, they have a much more propensity to pay down mortgages, particularly in an environment where house prices haven't fallen. In fact, they've been increasing over the last 4 months. So in that environment, you're in positive equity territory. There's no incentive to default on the loans. The banks really don't want you to default on the loans because they don't want to take those properties on balance sheet. They'd much prefer to either lengthen the term, work with you, move to an interest only rather than default on it. And in the worst possible situation where you are defaulted, bank shareholders, unfortunately, it's very fortunate to say, are going to be quite well protected in that with property prices increasing and a loan value ratio of 80%, there's enough to cover that loan. So very unpleasant for the people that do default, but it's probably not going to result in massive amounts of bad debt and erosion of capital for bank shareholders.
Yep. Well, thank you, Hugh, and it's so great to see you for the presentation today. All the best. Now, coming next, we have Mr. Craig Schloeffel, Head of Investment from Payton Capital. Payton Pooled Investment Fund is a pooled mortgage fund suitable for investors who prefer a managed investment experience, giving you access to a diversified pool of investments chosen and managed by Payton. The Payton Select Investment Fund is a non-pooled mortgage fund, suitable for investors who prefer to take a self-directed approach, allowing them to choose investments and reasonably tailor for their portfolio. Welcome, Craig.
Thank you, Angelina. So I'll start by telling you a little bit about Payton Capital. Payton Capital, for over 55 years, has been our clients, and most recently as a dedicated commercial real estate private debt manager. In our history, we've funded successfully over $2.5 billion in projects and currently manage a little over $1.1 billion AUM. We have offices in Melbourne and Sydney, and a bit of an exclusive, we've just launched an office in Brisbane. We have over 50 people, currently about 53, but every day we seem to be growing. And something different about Payton is we call ourselves a for-purpose organisation. And what I mean by that, it pertains back to our ownership structure. We're 40% owned by the Payton family, 40% owned by our own staff, and 20% of our business is owned by our own charitable foundation called the Payton Foundation. This foundation partners with 16 charities, both in Australia and around the world, and we use this to give back to the communities we work in. So, what is commercial real estate debt? Commercial real estate private debt is where commercial real estate loans are made to commercial borrowers to fund real estate acquisitions or property development. The loans may be used to purchase improved, or what we call completed product, developable or vacant land, or property that is completed or under construction. The land or property provides the security for the loans via a registered mortgage. The income is generated from the borrowers paying their interest and fees on loans, which we then return to investors. The Australian commercial real estate market in Australia is estimated to be somewhere between 50 and 60 billion and offers private investors the opportunity to take part in the fixed income arena and diversify their portfolio. Oh, all right, jumping here. So why does commercial real estate debt exist? It really started after the GFC led to a liquidity crunch worldwide, and largely through America, where banks weren't lending between each other. The private market saw this as a key opportunity to step in and fill the gap that the banks left. In Australia, more broadly, the Basel III regulations, which came in through 2016 onwards, meant that banks in Australia had much tighter lending obligations imposed on them by APRA. And where they're lending to commercial borrowers, they have to hold what's called a certain amount of Tier 1 capital ratio. This becomes very expensive for banks, and therefore they've chosen to step back from a lot of the traditional lending that they were doing. This, therefore, meant that private investors could step in and fill this gap and take advantage of a key opportunity to leverage a fixed income opportunity with fantastic risk-adjusted rewards. More recently, what we're seeing across the banking world is that clients or developers are getting frustrated with what we call the age of the slow no. And that's where developers are getting frustrated with banks who are coming with them on the journey, but throughout the course of a loan approval, getting further and further away from an approval and eventually coming to a no, or a slow no as we call it, where clients get left without a loan at the last minute. That's given a key opportunity as well for the private debt market to step in and fill this gap. Finally, a lot of developers come to the private real estate debt market because they're happy to trade off price for speed and certainty, which our market offers them. So that leads to, why would investors choose to invest in commercial real estate debt? And certainly it's a growing asset class in Australia. And as outlined earlier, it started in America, it's led to Europe, and now certainly maturing in Australia. So what it provides for investors is stable and regular monthly income, attractive risk-adjusted returns through all market conditions, capital preservation, as all loans are secured against Australian real property mortgages. It gives clients property exposure without the risk of ownership, and very low volatility and low to no correlation to public markets. Now, how do you choose a manager when you are looking to invest? And with any asset class, but particularly this asset class, it's very important to choose a manager who will provide you with transparency and integrity in dealing with your investment. So what you should look for is an experienced team. At Payton, our lending or origination team has over 150 years of Big Four bank experience within it. A track record. At Payton Capital, within our funds, we've never lost any capital for our clients, and we intend not to lose any capital for our clients for a long time. You should have a risk management focus and really look at what are the key risks that you're taking on when you're lending to any clients, and how are you going to mitigate these risks? And you should be able to easily articulate this in any investment. Direct origination. So where do the loans come from that you are lending your funds to give out to these developers? Does your team go out and directly originate the loans with the borrower themselves, or is there an intermediary sitting between? And finally, a specialist in their field. Within Payton Capital, there's a number of items that we look at that we think that we're a specialist in our field, and I'll quickly jump into them. One, we feel that we're a mid-market manager, and that means that we focus on debt sizes of typically $5 to $50 million. And at that size, we feel that it's less complex than the larger size deals, and that therefore lowers risk for our clients. So what does Payton Capital offer for our clients, and what are the investment options? And Angeline, you jumped into that earlier, thank you. There's two distinct options that we have. The Payton Pooled Investment Fund, which is a managed fund that allows clients to choose a pooled option or a pool of investments that clients can choose to invest in, which allows them to spread their risk and diversify across a number of different items, one being the investment type, the asset that they're lending against, the duration of the investment, the geography that they're lending to, and the developer that we're ultimately lending to at the end of the day. The benefit of this is that you get simplicity and diversity and allow Payton Capital as your expert manager to choose an optimal portfolio, maximizing return and minimizing your risk. The second option is the Payton Select Investment Fund. And this is where clients have the ability to self-direct their investment portfolio, choosing their risk profile and returning corresponding via contributory mortgages. And a contributory mortgage is where it's a single mortgage on a single asset, which has multiple investors. The benefit of this is that clients get to directly pick each and every loan that they enter into, and they have more power to choose their investment portfolio, managing their own risk appetite. Quick overview of the pooled funds. There's three distinct options. The Cash Plus is a combination of cash and first registered mortgage. And it's really more of a holding account for our clients. It's got a very low target portfolio LVR, including cash, and returns clients at the moment somewhere between 5 to 6%. Income is distributed monthly, and the liquidity of this fund is at call or 48 hours. With our core fund, this is our flagship first mortgage fund, and this is where it holds cash, some term deposits, but mainly first registered mortgages. The target portfolio LVR is still at 55%, so quite low relative to some funds. And the target investor return is somewhere between 8 to 9%. Again, income is distributed monthly, and there's a 6-month initial term on this fund with quarterly redemptions. Finally, the Opportunity Fund is our fund that holds a little bit more risk in that it carries first and second mortgages. It carries a target portfolio LVR of 65%, and it has target investor returns of somewhere between 10 to 11%. Again, monthly income distributions, and in this fund, there's an initial term of 12 months, and post that 12-month term, 6-month rolling redemptions. Quickly running through our Capital Select Fund. We have Capital Secure as our first risk category, or 5 risk categories if you like. Capital Secure, stable, balanced, growth and high yield. I won't run through all of these given our time, but the first 3 are first mortgage categories, and you can see at the asset types, the most secure is improved or completed property, moving through to capital stable that might hold some land, and then finally balanced is an active property or construction site. Finally, growth and high yield are second mortgage categories, growth being an improved or completed property, and high yield being an active property or construction site. With Payton Capital, we offer our clients a client portal, which means that they can log on and choose to view the value of their investment performance. They can see their average weighted return and their average weighted LVR across their portfolio at any time. We have both an online and an app that clients can choose to use. We're also listed for those advisors and clients that use direct the NetWealth platform, and we have both our Cash Plus product as well as our core product available for wholesale clients on the NetWealth platform. That's it. Thank you very much.
Thanks, Craig. Got a couple of questions for you.
Sure.
The first question is, in this growing non-bank lending environment, this landscape in Australia is growing, what sets Payton Capital apart from its competitors in this market?
Thank you. I touched on that slightly, and I was very conscious of time in my presentation. But the Payton Capital is what we call a mid-market lender. So our typical debt size is between 5 and 50 million. At Payton, we focus on the eastern seaboard. So our deals that you'll see from us are Victoria, New South Wales, and southeast Queensland based. Again, we see these markets having a deep pool of buyers if we ever need to realise an asset. We also see less volatility across these property markets. Finally, at Payton, we have a distinct focus on residential. And when I say residential within the subclass of property, that means a mix of greenfield land with development approval or greenfield land under construction for housing lots, infill land sites within city boundaries, apartment construction, or townhouse or housing development. The final part to our fund that you'll see is commercial or industrial business parks. We certainly have a few of those within our fund, and we still are very bullish on that asset class as we continue to see growth in the sector. Finally, at Payton, you'll see shorter duration across our deals. So typically 12 to 18 months is a duration that you'll see across a Payton Capital deal.
Well, given the heightened risk across various asset classes in this, current economic climate we're in, how does Payton Capital effectively address and mitigate its risk within, let's say, the commercial real estate private debt space? That's where you play in.
Yeah, thank you. Well, like most asset classes, there's many factors that contribute to risk. And within property itself, there's many subclasses. You've got residential, commercial, you've got hotel, industrial, retail, specialist retail. There's many subclasses of property. And the way we look at it is that we see the current environment certainly more challenging for borrowers, with many uncertain factors to consider. Construction costs are starting to come off. Delays are certainly still there. There is still some supply issues, and the availability of the end buyer to afford the product that they're building is now more than ever making feasibilities difficult to stack up in this cost environment. Having said this, the fundamentals of our book, made up in 85% residential property, certainly gives us some tailwinds because of the factors that are supporting residential property. Across these submarkets, residential property, we feel, has the greatest ability to pass on some of these increasing costs that make property segments less stable as we look at increased rents, therefore increased yields on direct property or residential property, the lack of supply of residential property coming through in all of the three markets I mentioned, and certainly increased demand given the 900-odd thousand new Australians that will be landing on our shores over the next couple of years. And we know of those Australians, 70% will fall into Melbourne, Sydney, Brisbane markets. So certainly for us, when we look at risk, within the subclasses, we feel that residential property is well positioned to weather some of the storm that we've seen. What I will say for the listeners is that we feel that a well-positioned first mortgage investment with a great manager will always provide investors an amazing risk-adjusted return to consider in any portfolio.
Well, thank you, Craig.
Thank you.
Have a good night. Take care.
Thank you. Cheers.
The Centuria Agriculture Fund is an open-ended unlisted property fund that aims to provide investors with stable income returns and the potential for capital growth by investing in a diversified agricultural property portfolio. Our speaker tonight is Centuria's Agriculture Fund Manager, Mr. Kelvin McKeown. Having grown up on multi-generational family sheep farm in New Zealand, Kelvin has been involved in agriculture his entire life with a broad and sound knowledge born from practical experience. Prior to Centuria, Kelvin worked at Macquarie Groups for 14 years, managing unlisted agriculture funds that owned and operated large-scale horticulture, viticulture, and forestry assets. Kelvin's topic tonight is Agriculture investment fundamentals. Why invest in controlled environment agriculture? Welcome you, Kelvin.
Thank you, Angelina, and thank you for that lovely introduction. Well, as Angelina said, my name's Kelvin McKeown. I'm the agriculture fund manager here at Centuria. For those of you who don't know Centuria, we are one of Australia's leading property fund managers. We're listed on the ASX 200. We have approximately 21 billion of funds under management. Over the last 3 years or so, we've been investing in the agriculture space. Over that time, we've developed 3 different agricultural property funds with approximately $500 million of assets under management. We've got quite a diverse range of assets from stone fruit orchards to citrus orchards, from almond orchards to vineyards, from tomatoes grown under centre pivot irrigation through to market vegetables and fruit and vegetables. And then more recently, we've been acquiring glass houses, which brings me to the fund I'm going to talk about today, the Centuria Agriculture Fund. So this fund launched in July last year, so we've been operating for approximately. It's an open-ended fund. We're targeting very, very high quality and sustainable agricultural investments. To date, we haven't been taking any operating risk, so we've been buying these assets, leasing them to very, very strong and very, very experienced tenants, and mainly through triple net leases, so very, very, very long triple net leases. The agriculture sector that we've been targeting at the moment is what we call protective cropping. Protective cropping is a vast array of different agricultural assets, from blueberries grown under hail nets to strawberries growing in polytunnels to mushrooms grown in sheds, or tomatoes grown in glass houses, which is the very, very, very top of the protected cropping sector. And we always say, if you're going to start anywhere, you might as well start at the top, and that's what we've done. So the last 12 months, we've managed to purchase 3 very, very large-scale glass houses within Australia. The fund is now the largest owner of glass houses in Australasia, with around 73.5 hectares under glass. And the assets under management for the fund now total around 323 million after 12 months. So it's an achievement that we're very, very, very proud of. So why ag? Why Australian ag? Well, the underlying thematic always comes back to demand, and it's the demand that's increasing, and it's increasing from the growing middle class, the growing global middle class. So the middle class population is expected to increase from around 3.8 billion today to around 5.4 billion by 2030. So it's a huge increase in mouths to feed. These are people that are going to want to eat more food, a much larger variety of food, much more high quality food, and safer food. And that's very, very, very important. The majority of this growth is going to come from the Asian markets. So Australian farmers have a very, very large competitive advantage with their proximity to those markets. We also have another huge advantage over here because we're globally known as very, very good farmers, and that can produce a very, very large variety of food and very high quality food. And the most key factor is a safe food. But your typical Australian farmer, they operate in an environment of climatic extremes. And as we've seen more recently, the natural disasters in this country seem to be more frequent and more intense as a result of climate change. And this is one of the reasons that we've identified protective cropping as a good agricultural sector to get into. So you're able to mitigate all your climate risks, so your droughts, your frosts, your floods, your fires, and then also your pest and disease risks. Because you're able to grow your produce within a controlled environment, you're able to significantly increase your productivity while significantly reducing the amount of inputs that you require. You're also able to produce all year round. So some of the crops you can only produce in winter, in summer, and can't produce in winter. Where under a glass house in that controlled environment, you can produce all year round. and you can produce a consistent quantity and a consistent quality. Now, this is what the end consumer wants. By doing that, you're able to strengthen the financial security of your tenant. So we know that they're going to have less risk of crop failure due to the climatic conditions. So we know that they're going to be strong and they're going to be able to sell their produce all year round. And that's the sort of tenants that we want. On to the sustainability piece and the ESG piece. It's all about the production piece as well for glasshouse production or protective cropping production. So a lot of people use ESG as a marketing tool. We've got hard facts to back up the benefits of growing within a glasshouse. And what we'd like to do is compare ourselves to growing tomatoes out in the field. So if you're growing tomatoes in the field, you'd expect to produce somewhere around 69 tonnes per hectare. When in a glasshouse, you produce 800 tonnes per hectare. So it's a really, really significant increase in production. With water usage, which is such an important resource in this country, you expect to use around 116 litres of water to grow 1 kg of tomatoes out in the field. Where in a glasshouse, you only need 22 litres of water. The reason that there's such a less requirement of water within a glasshouse is that in the environment, you're able to recirculate, recycle, and sterilise that water so it keeps getting reused and run back through the system. There's other benefits as well. When growing out in the field, you expect that your wastage is going to be somewhere, and it can be up to 30%. Where in a glasshouse, it's less than 5%. It's also much less reliant on fertilizer and your pesticides because you can control that environment. And if you do have an outbreak of bad bugs or bad insects within a glasshouse, very simply, you introduce good bugs to fight the bad bugs. So moving on to one of the 3 assets that we recently purchased. This is the Sundrop facility that's located in Port Augusta in South Australia. We purchased this asset in December last year. So Port Augusta ticks one of the boxes that's really, really important for glass houses, and that's sunlight hours. Port Augusta is pretty much in the desert, so a huge amount of sunlight hours. More sunlight hours, the more production within a glass house. The only thing that's really letting this site down, though, is its access to water. Annual rainfall in Port Augusta is around 200 mils a year, so it doesn't have very, very strong access to fresh water. To solve for this facility has a pipe that connects it to 5-kilometre pipe that connects it to the Spencer Gulf. And it sucks salt water out of the Spencer Gulf, and it uses it for a number of different reasons. The first of all is to run through an evaporative cooling system that's attached to the glass house. So the salt water is run through this evaporative cooling system, it cools the glass house down during the heat of the day, during that because it's in the desert, and that controls that climate. Essentially, you don't want the inside of your glass house being above around 28 degrees, or the tomatoes will stop growing. Next, the salt water is run through a desalination plant. The desalination plant is powered by this large solar energy system that you can see on the screen at the moment. So that's 12.5 hectares of mirrors. It's not a solar energy system like we think of on our roof that's generating electricity. It's a solar energy system of mirrors, 24,000 mirrors that are all computerized, and they follow the sun like a sunflower. And they direct and focus all that sun's energy and rays into the top of that pole there. And you can see it at that black point. What that does is it superheats that salt water. It creates steam. That steam spins a turbine. That turbine creates energy. That energy runs a desalination plant. The desalination plant creates fresh water. That fresh water is then used to feed the tomatoes. On top of that, all that hot water is then stored in the tanks at the bottom of that pole. That hot water is then run through a piping system within the glass house and heats the glass house up during the cold of the night. So it's an incredible piece of technology that combines this natural resource technology and ag technology to grow tomatoes. The facility itself can grow around 17,000 tonnes of tomatoes a year, which is approximately 14% of Australia's truss tomato supply. The facility has a 10-year take-or-pay agreement with Coles, which is a very, very rare agreement. We don't believe that these have been given out in the last sort of 10 years. It supplies Coles with over 90% of its annual truss tomato requirements. So if you're going into a Coles supermarket and buying truss, there's a very, very, very high likelihood that it'll be from this facility. They have a very strong relationship with Coles and Sundrop. Within 48 hours of a tomato being picked in the facility, it'll be on a Coles shelf anywhere in Australia. And they love the state sustainability piece, and you can see that there's a number of sustainability awards that Sundrop have won. That's the end of my presentation. If any of you out there are interested in the investment or want to discuss it more, these are some of the details for our sales team.
Thanks, Kelvin. I do have a question regarding tomato and glasshouse. Very interesting to me. But before we get to that, I do want to ask you a question about the predictability and the risk of your future cash flows. Now, given that your lease structure and the hedging of that provides a level of certainty around the cash flow, the only potential variable perhaps is tenant leaving and not being able to pay the rent. So how do you manage this risk through your due diligence or in your worst case scenario, how would you find a new tenant if an existing tenant just cannot afford their rent?
Yeah, thank you, Angela, and it's a very, very good question. When you're looking at facilities like this, it's very different to looking at other property investments such as an office block or a large warehouse. So as part of our DD, we have to do a real deep dive into the production capabilities of the glasshouse, and along with that, what the costs are to run the glasshouse. So we need a really good understanding of what the EBITDA is and what the EBITDA for the last sort of 5 years is, what the risks are to the EBITDA, and what it's looking like for the foreseeable future. From there, we can understand, okay, well, this facility itself is secure. If the tenant was to go under for a reason outside of this glasshouse, then we'd be able to find another tenant for the glasshouse because the facility itself isn't able to stand on its own 2 feet. Now, a lot of people might say, well, it's very rare to be able to find these tenants. It might be very difficult to find a new tenant for a glasshouse because it's such a unique skill set. What we believe is that this is absolutely critical infrastructure for the supply of tomatoes to Australia. So, as I said, that one facility, Sundrop, supplies Coles with up to 90% of its truss tomatoes on an annual basis. So if it went offline for any reason, then that would severely impact the supply of truss tomatoes in Australia. So we think that Coles would be very, very interested in resolving that solution and making sure that tenant continued, or not that tenant, but the facility continued. We also now have 3 of the 5 major glasshouse operators as tenants. And we think that all of them would be very, very competitive and want to get their hands on the glasshouse to increase their production if one of them was to come offline.
Thanks, Kelvin. Now, here's my question about the tomato. Assuming Australians and the growing middle class of Asian countries continue to eat tomatoes, assuming glasshouses will become really prevalent and scoped out and very popular, are you interested in acquiring more assets, and are you potentially looking to work with distribute any new glasshouses? Either of these 2 approaches be accretive to the fund, and why not?
Yeah, no, very good question again, Angelina. So we currently in Australia, there's around 215 hectares of commercial scale glasshouses. We now own 73.5 hectares of that 215. We think there's maybe a couple more glasshouses that we might be able to acquire before we run out of existing glasshouses. And then from there, we're definitely always looking at development projects. So the Sundrop facility, as an example, It was built, it's currently a 20 hectare glasshouse. It was built with the idea of it being a 30 hectare glasshouse. So you can quite simply build another 10 hectares and plug it into that existing infrastructure. So it's significant cost saving from starting from scratch. And also all the major supermarkets are speaking with us about, okay, well, what sort of crops can we grow in glass houses, and how can we increase the supply? The major supermarkets really love produce that's grown in the glass house because it's that consistent quantity, consistent quality, and the production's all year round.
Well, thank you, Kelvin. It's a great presentation. Thanks for the Q&A. It's good to see you. Take care.
Thank you very much, Angelina.
You're now watching the Property and Income Perspective of the Investment Markets July 2023 Investor Seminar. Coming up, we have a speaker from the Woodbridge Private Credit Fund. The fund provides investors with direct and indirect exposure to first mortgage, meaning senior secured, in Australia and New Zealand, the real estate loans with an ESG integrated investment process in place. All loans in the portfolio have a valuation prepared by an independent, qualified, and registered value. Fund does not provide exposure to high-risk loans such as preferred equity loans, mezzanine finance, second mortgage loans, or corporate loans. Our speaker today is Mr. Andrew Torrington. He's a founder and managing director of the Woodbridge Private Credit Fund. Welcome, Andrew.
Great, thank you. So as the title gives away, I'd like to probably spend my time this evening not talking about how good private credit is or telling you how investors can super earn in this asset class. It's probably more to focus instead on investors who are looking to invest in private credit to understand three important things. And really those are that not all loans are the same in private credit, not all private credit funds are the same, and of course not all managers are the same. And really, we're just encouraging investors in this asset class to think differently about private credit. There's an absolute opportunity to invest in private credit, but investors need to understand the asset class. So a good place to start, of course, is, we should call out up front that this industry suffers from a little bit of lack of transparency and what we call opaqueness, and that there's a lot of lack of transparency around loan portfolios in the industry about where the risk of loans are and, of course, fees. So what we're doing really this evening is just running through the loan types. So the place to start with loan types really is there are four main loans in private credit that these funds are doing. Of course, we've got the Woodbridge Private Credit Fund, which is a first mortgage strategy, and that sits lowest on the risk curve of loans. And their fund's currently doing 9.72 net to investors. These are asset-backed loans with a first mortgage on them. The next type of loan class you'll see is corporate loans. These are typically backed not by assets, but backed by balance sheets and cash flow. Those loans are typically in the market earning 8 to 12%. You then got second mortgage loans, which are subordinated loans to the first mortgagee. So they sit between the first mortgage and equity holder. Those loans in the market typically are earning 15 to 20%. And then you've got what's called preferred equity loans, which are earning plus 20% in the market. So four very different loan types, four very different loan risks, and four very different loan returns. So with that in mind, when you look at private credit, you need to take those four different loan types and ask, when you're investing in private credit, what type of fund is it? So what's most typical in the market at the moment are what's called blended funds. So blended funds are a mix of first mortgage senior secured loans that are first on the cap stack, second mortgage loans that are junior to the second, corporate loans. So as I just showed you in that previous graph, all three of those loans have three different risk profiles, and they all have three different return profiles. So when you invest in a fund that's blended, what you get is blended risk and returns. What I call in here as hidden returns, because you really can't get to see the underlying loan risk you're taking. But I think importantly for investors, and certainly wealth advisors investing in product, you can't measure the spreads in a blended fund because the spread is a blended spread. So, of course, what we're selling at Woodbridge is a non-blended fund, and this is a first mortgage only single strategy fund that gives investors one single loan type. And obviously, we believe the best risk-adjusted returns in credit at the moment are in first mortgage, but it gives what's called a non-blended fund. So single loan type, it's transparent. Investors can measure the risk and the returns they're getting of these type of funds. And of course, they can measure the spreads. So what I would encourage investors to think about in private credit is think alternatives for blended funds and that the risk and return profile sits in that bucket. And for first mortgage funds, think fixed income, as in low volatility, capital preserve, spitting out returns of sub 10%. So that's the way that we cut through blended and non-blended funds, and we'd obviously encourage investors to do the same. The next slide's not particularly favourable with my peers in the industry, but there's really 10 questions that investors need to ask these funds as they come in. The first one is, as I just pointed to, is it a blended fund? Do you have multiple loan types in the fund? And if you do, tell me what the split of those first mortgage loans, second mortgage loans, corporate loans are. Give me the math of it and show me the LVRs of those first mortgage, second mortgage, corporate loans, and show me the limits then of the fund in each asset, in each loan type. So what that gives investors is transparency of the blend. Much easier to see the transparency in a non-blended fund because you have a single loan type. The third question to ask, of course, is, specifically to the fund, is that if the fund is non-blended, does the IM allow it to invest in other types of loans? And specifically, that's important because some funds will say, no, we don't invest in this type of loan, but the IM will say they can. And if they can, they probably will, and they certainly won't come back and ask your approval. So once again, it's transparency of what the IM is saying that the fund can do. Number 4 is important in private credit, and as I mentioned, private credit suffers from a distinct lack of transparency in this piece, which is, can the investors see the loans in the loan book? Can you actually see what loans are in the portfolio, what the LVRs are, what the values of the loans are, and the status of the loans? If you can see the loans and you can see the loan types, then you can assess spread. If you can't see the loan book, then assessing spread is impossible, and of course the risk associated with it. Number 5 is not common in industry, but very important, is that does the fund have an external trustee? What's been quite normal in the industry is that funds are their own trustee, but I think we certainly push investors to make sure that the fund has an external trustee, make sure they're independent, because if they are, then they're there to represent the interests of investors, not of the investment manager. Leverage is an important issue, and we've seen it with a few banks in the US, but does your fund have leverage? And I don't think investors ask this enough in this asset class, because if the fund has leverage, it's probably using it to spice up returns. But importantly, if that leverage changes, the fund could be locked up. So once again, ask the manager, do they have leverage, and does the fund IM allow them to put leverage in? Obviously, we're talking about a loan book. So the loans typically may go in and out of default. They may be good defaults, they may be okay defaults, they may be bad defaults. Ask the fund what loans they have in default. Specifically ask them if any are in receivership. And if you can't see the loan book, then I would politely say don't trust the answer. And in terms of loans in default, there's multiple reasons why loans can be in default for a fund. Is that ask why, and investors just need to get used to asking this. But ask the investment manager how long they've been in default. Is the fund earning default interest? If not, why not? Is there any impairment risk on the loan? But drill through the questions. Don't just don't take the manager's word for it. I think it's also important, just in terms of being transparent, is that ask the fund manager or indeed the investment manager, whether they have any related party interest in loans, i.e. are there any loans in the loan book that the fund is lending to itself? I think, once again, unless you can see the loan book, you can't see who the ultimate borrower is. And finally, for investment managers and funds that have multiple funds, are they moving loans from fund to fund? Can they do it? And are they doing it? So once again, for investors, just transparency around loan books. What you see is what you get, and that you know exactly what's in there. So, of course, for Woodbridge, we say we're different. And, of course, we say we're different as a business, and we say our fund is different. So, for us, we are a fully transparent fund. We don't hide loans. We don't hide fees. We're generally trying to be transparent with our investors about our loan books. We do monthly reports on all our loans. We're what's called a non-blended fund, as I mentioned. So, we have single loan types. So, we are first mortgage only. The reason we are first mortgage in this market is predominantly because of asset price stress. So we believe the place to play for the returns we're getting for investors. We have an external trustee. So the external trustee actually also sits on our credit committee. The external trustee is there to make sure that our investment strategy is held and that we don't invest in loans that our IM says we can't invest in, and or we take risk above what our investors are expecting. So external trustee is important to protect investor interests. We run a ESG framework, so we've got a fully integrated ESG framework. I understand some wholesale investors don't probably know what this is or know why they need to care about ESG. I would explain ESG in private credit as responsible lending, responsible investing. So investors know what they're lending in. For example, we can't lend in petrochemical, petrol stations. We can't lend in poker machine venues taking advantage of low socioeconomic areas. So there's some pure things like that. But for investors, it gives you confidence that we're not investing in assets that you wouldn't want to ethically be invested in. And of course, we would say that we know our asset class very well. We've got a long history in asset ownership, equity and lending, and we've done first mortgage and second mortgage strategies before. As I mentioned, we believe first mortgage investing at the moment is the absolute place to be for investors in private credit. And for a fund, currently doing 9.72 net to investors, we're 100% senior secured first mortgage fund governed by an external trustee. 100% of our book has floating interest rates with a floor, which obviously gives investors a hedge against inflation in this market. And we've got a pretty low LVR across the book of 58% in the fund. So for the fund itself, so the benefits for investors really are that, high single digit, it's an attractive risk adjusted return, first mortgage portfolio, stable monthly income for investors, 100% of distributions paid monthly to investors, low capital volatility. We say that because we're a first mortgage fund. So at an LVR of 58%, for example, what you are protecting yourself is a 42% hit on the asset price. So nothing's capital guaranteed, but capital preservation is certainly at the heart of a first mortgage fund. Fully floating rates, so obviously gives investors a hedge against inflation. I think when rates start to fall, investors need to turn their attention to making sure that fund managers have floors in their loans, that your returns don't go backwards, which we do. Experienced investment team, we don't invest in high risk loans, second mortgage, corporate loans, pref equity loans. The fund has a low management fee of 50 bips to investors, and our minimum investment is $25,000. So liquidity is monthly best endeavours to investors and quarterly buy redemptions. And just to repeat, really, so for investors in these type of funds, we think of ourselves as fixed income, not alternatives, because we're a first mortgage pure fund. So that's where we think we sit with the investor portfolios. Thank you.
Thanks, Andrew. I got a question for you here. You mentioned first mortgage. Why are first mortgage loans better in this macro environment?
Listen, there's a lot of press in the market at the moment about falling asset prices in commercial real estate, and in particular in office as an asset class. And obviously, if you're an asset owner, that is a concern for you, given the high interest rates, the lending rates you've got as an asset owner. think people need to understand that we're not asset owners, of course, we're asset lenders, and that we don't own the asset, we're lending money into the asset. So when an asset falls by 10 or 20%, as we've seen in some office assets, is that as an owner, that's very concerning to you, and you're obviously losing pure equity. As a lender, we're not. It means our headroom has shrunk, but we absolutely have not lost any money if an asset falls by 20%. For example, as I said before, if the LVR of the fund is at 58%, we're talking about a 42% hit on an asset price before we would ever have a loan impairment. So for investors, just separate REITs, asset owners, very different to private credit funds that are taking short-term credit risk, typically of 18 months, versus asset owners that are in there for the long term and the full asset cycle.
Yeah. And we see a lot of press on falling asset prices, for example, on offices. How does the Woodbridge Fund protect itself on falling asset prices?
So the fundamental protection for falling asset prices is first mortgage. So, and what that gives us is we completely control our assets. So at any time, if we want to step in on the asset or we think the asset price is falling to a level we're uncomfortable with, we can step in on the loan. Step in means that we can put the borrower in receivership, we can sell the asset on the market, and then we can get our money back. So the asset protection on falling asset prices is the first mortgage protection, which in Australia is absolute, and our LVRs. We run very conservative LVRs across the fund. So, we're talking about hits to assets of plus 40% for us to have a loan impairment. So at any time the asset value shrinks by 10, 20%, we're protected. And if for any reason it starts to hit 25%, we would simply sell the asset, recoup our investment money earnings, and then the borrower gets the residual.
Thank you, Andrew. Great to see you. Have a good night. Coming next, we have the Divisional Director and Head of EG Private Wealth, Mr. Rodney Walt. EG is a prominent independent funds management firm that specializes in Australian real estate. Their division, EG Private Wealth, has been assisting wholesale investors for over 2 decades, combining the agility and drive of an entrepreneur. Recently, they formed a partnership with M Squared, an alternative credit specialist, to provide investors with private debt opportunities. EG's private debt deals primarily goal is to deliver returns of 8 to 12% per annum to investors. They achieve this by focusing on high-end residential and industrial real estate, maintaining a LVR, a loan-to-value ratio, ranging from 50 to 75%. Rodney is a divisional director and head of EG's private wealth division. During his tenure, Rodney has been at the forefront of EG's expansion into prop tech and fintech innovation and acquisition, which notably led to EG's investment in global technology platform Willow Inc. Rodney is going to give us an overview of EG private wealth and share his knowledge on private credit. Welcome, Rodney.
Thank you very much. Great to be with you. And thank you all. I look forward to sharing my presentation and telling you a little bit about who EG is. So EG is a leading independent real estate funds management firm specializing in Australian real estate. We invest in, develop real estate on behalf of our institutional investors and wholesale clients to generate outstanding returns and lasting positive social impact. EG's business has grown off the back of its technology platform Prisms, which is our proprietary property risk management software, which was created in 2008. It has been the software used in assessing, identifying, and pricing risk in real estate for equity acquisitions. It is the reason today that we manage north of 5.1 billion in assets under management, have a development pipeline of 3.9 billion, 20 years of experience, and 112 plus staff across 2 countries. The software has led to us delivering a realized return of 16.7% of IRR over the past 20 years for our institutional investors. EG's disciplined, data-driven approach to risk management has enabled us to safeguard our investor funds while maximizing returns. EG established private wealth to introduce income-producing and capital growth opportunities for our exclusive network of wholesale investors and family offices. We've been able to create bespoke commercial real estate equity and debt opportunities for our clients. In the private credit space, EG established its private debt division focusing on institutional investors in 2020. We recognized that there was also an opportunity for our wholesale investors within private debt markets. And since then, EG has joint ventured with M Squared to provide our wholesale investors with access to private credit opportunities. M Squared has been around for 8+ years and has a strong track record in bringing extensive knowledge to the non-bank lending market, along with access to borrowers and brokers. EG will integrate its PRISMS platform in providing and assessing risk in credit quality to safeguard our investor funds, and we are heavily focused on the downside risk. We are able to underwrite deals with an equity lens, utilizing our PRISMS platform and assessing the risk based on vacant possession and owning the asset. We continue to provide our investors with a personalized service in delivering these outcomes and returns. How does our credit assessment process work? We really believe in the 5 C's: understanding the collateral, the character of the borrower, the capacity for them to repay, the cash flow, and the competency. As we all say, the best loans are those that get repaid, and underlying and underpinning this whole platform is our PRISMS platform. EG's disciplined, data-driven approach to risk management has enabled us to safeguard our investor funds whilst maximizing those returns. In the private credit space, we've really targeted 2 areas. And the 2 areas that we will continue to focus on in the current market is in the high-end residential first mortgage borrowing. So these are typically bridging loan facilities in the high-end locations of Sydney's eastern suburbs, lower North Shore, and inner east of Melbourne. The typical borrower is a high net worth who is looking to upgrade to their next property. They are needing time to bridge between the 2 loans. And the current banking sector is really struggling to provide loans for borrowers where they are not able to meet the cash flow. But we understand the inherent value in the 2 properties and the significant capital that they have invested in both properties. By providing a first registered mortgage, personal guarantees, we're able to provide our borrowers an opportunity to upgrade to their new properties. And the loan sizes in this space is typically in that 8 to 25 million mark. And we're leveraging between 55 and 75%, including all capitalized interest. And the average duration is in the 6 to 18 months. And the target returns that we'll be offering our investors is that 8 to 12%. And that really largely depends on the level of LVR or loan to value ratio that the borrower is looking to borrow against those properties. With the influx of people into Australia, we're still very confident in these sectors and providing our investors the opportunity in the private credit space. The second sandbox that we'll be focused on is very much in the industrial real estate logistics space with owner-occupiers who are looking to reposition their business post-COVID. So we're focused on established locations in the East Coast, owner-occupiers, first mortgage, with those typical properties, those industrial locations, having no gantries or chemicals, personal guarantees, loan-to-value ratios in that 55 to 70%, the average loan size is in the 10 to 30 million, with the duration of 12 to 36 months. And the target return that the investors can expect from these opportunities is in that 9 to 12%. In terms of recent transactions, we've recently provided a bridging facility opportunity for our investors. The property was an eastern suburbs location with a valuation of $10.55 million. The borrower was looking to borrow $7.1 million in a bridging loan facility. So a loan to value ratio at 68% on initial term. And that was for a term of 9 months with a minimum term of 4 months. Our investors who invested in this opportunity are now currently receiving close on 9.5% variable, which means that they are receiving a return based on the RBA cash rate of 4.1% currently, plus a margin of 5.4%. And that is net of fees, and that is paid monthly to our investors. In terms of the private credit team, you have myself, Rodney Walt, who've been part of the EG team for over 13 years. Chris Pack, who is our joint MD and Chief Investment Officer with 20 years of experience, Chris has managed over 10 billion in real estate equity and debt transactions. And during the GFC, he completed the workout of the Howard Mortgage 3 billion book, returning all equity to investors. He's deployed over $1 billion in loans for super funds and sovereign wealth funds. Paul Mirren and Paul Aliotis are the two founders of M Squared, and for over the past 8 years, they've delivered and created extensive opportunities for their clients. Paul Mirren is respected and recognized for his economic views and ability to mitigate risk through well-considered structuring of products. Paul Maliotis is well regarded and has a vast network of trusted industry contacts. Paul's wealth of on-the-ground experience has a wealth of on-the-ground experience in the private lending space. So, in summary, if you're looking for a trusted, proven performer with the ability to provide private credit first mortgage opportunities with loan-to-value ratios in that 50 to 75%, including capitalized interest, flexible loan terms of 6 to 36 months, please reach out to me, Rodney Walt, or my team to assess and access opportunities for our wholesale investor market. Thanks very much.
Thanks, Rodney. We have some questions for you. The first question is, why private debt?
Why private debt? Well, at the moment, you've got high inflation and interest rates being relatively high. And that is proving quite challenging in finding equity opportunities in the commercial real estate sector to invest in. We believe that at the moment, private credit provides our investors with a good risk-adjusted return. Until we understand where the risk-free rate is going to land, there's a better opportunity for our investors to be investing in private credit.
Right. And why EG for private debt?
Why EG for private debt? I suppose a lot of that really comes down to our Prisms platform, understanding those opportunities with an equity lens. So obviously we've got the M Squared guys who have long established relationships and opportunities and understanding on the private lending space. But I suppose we bring an opportunity where we're able to access and look at those opportunities with an equity lens, understanding what would happen if we had vacant possession of those properties. Many of those opportunities that we've looked at recently, we've actually looked at acquiring. And where we're lending to those properties and borrowers, we understand what the risk-adjusted returns might be for our investors.
And where will EG target investments in the private credit space?
So at the moment, we really are focused on that high-end residential space, as well as the owner-occupier industrial space. In time, I have no doubt that EG will expand into looking into other private lending opportunities, be it construction. We obviously have our own in-house DM and PM team, our own urban planning and team that could assist in those opportunities. And where we do expand into that space, it will be at the right time. Right now, we believe that the sectors that we're targeting are the right space on a risk-adjusted return for our investors.
Well, thank you, Rodney. Great to see you. Take care.
Thank you very much.
Our last speaker from the property and income perspectives is Mr. Chris Carrigan, Head of Property Investments from Quanta Investment Funds. The Quanta Southeast Queensland Office Trust is a high-yielding Southeast Queensland office investment with inbuilt capital growth potential plus several value-add opportunities. The investment is 99% leased and underpinned by long-term leases to government and ASX top 50 companies, including some of Australia's most well-known brands. Chris brings over 20 years experience in acquisitions, investment management, and leasing. He has held senior management positions with large institutional and corporate real estate investors, including QIC and Melfa Australia Limited. Chris has been the responsible executive for a portfolio greater than $2.5 billion throughout his career and has been a key driver of growth in these portfolios. He's going to tell us the new investment opportunity. Welcome, Chris.
Thanks, Angelina. Yes, thanks for letting us, giving us the opportunity to talk today. We're very excited about that upcoming investment opportunity. But before we do, I was keen to give an idea of who is Quanta, what we do, and the types of investments we what we invest in. So just as a little about Quanta, we're a Brisbane-based fund manager. We've been operating for some around 10 years under various corporate structures. Our current portfolio is a little over 300 million in assets under management. We're a multi-sector specialist, so that means that we're not predisposed to any one sector. We invest in office, retail, industrial, health. So we're somewhat agnostic in our approach. Our investors are wholesale investors. Their investment in our investments range in size from as little as $40,000 up to our highest investor, which is around $50 million. And here in Brisbane, we've got an office in Queen Street with around 35 staff, where we have investment management, acquisitions, property management, and project management. So our investments, we most typically invest in retail, industrial, office, but we also take a position in other other sectors such as health, where the returns and the quality of property matches our investor appetite. Our investment style is typically what's known as core plus to value add, and so that's really, when you talk about a risk return ratio, core plus is very stable commercial asset with long-term leases. Value add is core plus, but adds a value twist to it. And I've got a couple of practical examples to talk through those two investment styles. The markets that we invest in are, again, we're not predisposed to any particular market. We're invested in most states throughout Australia. We do like to be able to deploy localised management expertise where we can. So the assets that we've acquired most recently and the assets we're talking about with our new opportunity are all in southeast Queensland, very close to our office. The return profile we look for is to be able to offer investors a strong underlying distribution of 8% or greater, and we pay that monthly. That's 8% net of fees paid into the investor's bank account monthly, and an equity IRR of between 11 and 18%, and that varies depending on the profitability or the value add aspects of the investment. So our funds, we're transitioning the style of investments we offer to investors. We no longer look at pooled open-ended funds that don't have a defined exit date. We strongly believe that an investment strategy has a origination phase, a value creation phase, and an exit phase. And typically we're finding that's in 5 to 10 years. So we return investors equity to them out of that investment at the end of that 5 to 10 year period. That seems to be the overwhelming preference of our existing investors, and they also, rather than investing in pooled funds, they like the choice of defined assets where they know which assets they're going to invest in, rather than being blind to the actual assets when the manager picks them and grows the funds through a pooled fund. So this is our portfolio, 21 properties spread across all but 3 states in Australia. They're in 8 trusts currently valued in the order of $310 million. To explain the difference between those two investment styles of core plus and value add, this is 2 retail assets we acquired last year. The property on the right is a convenience centre, service station, and has medical assets, and it has long-term leases, medical medical tenants, service station tenants, and doesn't have expiries for a long time, and so it doesn't have a lot of value add to it, but it's a safe, secure, safe harbour, and that's a classic core plus investment. We offered that at 6.5% distribution to investors, which reflects the low risk nature of that investment. Another core plus investment we made during the year was the Launceston Everyday Retail Centre, which was 100% leased to the likes of Supercheap Auto, BCF, Beacon Lighting, Rabobank. The strategy with this asset is, again, it's core plus, so it's long-term leases. There isn't a construction or value add twist to it. It's renew the leases, achieve rental growth on renewal, and then sell that asset on a higher net income in 4 or 5 years' time. So 157 Ann Street was a third deal we did last year, and this is a very good example of a value add investment case. We bought a building that was previously owned by a Goldman Sachs entity. It was 48% leased, so there was some leasing risk in it. We acquired the building with a prospective tenant in hand. We purchased the building with a leasing commitment that really took occupancy up to about 90% by the time we settled the property. So there was a lot of value delivered by purchasing up. We bought at a price that reflected the building was only 50% occupied, but returns are based on, and the capital growth is based on having a tenant that takes out most of the vacancy. We've since leased the rest of, in the 9 months that we've owned this asset, leased the rest of the building. So that's now 100% occupied. We bought the building for 39 million, spent 7 million. It's now valued at 59 million. So it's been a very compelling value add investment style. So if I move to the Southeast Queensland Office Trust, which we are bringing to the market, this is an office investment of 2 assets, and it will only ever be 2 assets in a single trust that will be has an investment horizon of 5 to 7 years. It's 99% occupied, and over 70% of the leases, over 70% of the area is to either state government or some of the best tenants in Australia. So the property in the top right-hand corner there includes Queensland head office for Bunnings, Queensland head office for Coles, Queensland head office for Wesfarmers. It includes Panasonic, National Australia Bank, and some other private sector tenants. So the property on the bottom, right-hand corner is predominantly leased to state government. So between the 2 properties, we've got a very robust mix of tenants, and there is inbuilt capital within their inbuilt capital upside in their leases through fixed rent reviews, so the rent will grow. We think that when we renew these leases, there is room for rental growth, and there's also some surplus land that comes with the Limestone Street tenancy on the bottom right, that we believe we can get a DA on and sell in the medium term to a developer when the developer market returns more strongly. So that's really, they're both Southeast Queensland, so our management teams are very close to both assets. As I say, it's a 5 to 7 year investment, and we will be looking to close investment applications in August and settle the properties in late September. So That's the Southeast Queensland Office Trust. Why Southeast Queensland? Southeast Queensland is a very strong economy at the moment. It's one of the strongest economies in Australia at the moment. Net migration in Southeast Queensland is the highest in the country. And of course, there's what we're calling the golden decade of growth for Southeast Queensland coming up with unprecedented levels of infrastructure, the Olympics coming up, and construction in the area. So it is a very compelling place to invest, and we think that over time, in addition to the net income growth and the value add initiatives that we have at that property, Southeast Queensland as a precinct to invest is going to be very strong.
Thank you, Chris. Now you explained why Southeast Queensland, but can you explain why office?
So the office sector, we're agnostic, as we were saying. We look at easily over 100 deals a year and end up doing usually only 3 or 4 deals. And we look at mostly industrial, retail, and office. Office has had a genuine reset in pricing that the other sectors haven't seen yet. Price of shopping centres is not as strong as it was, but it's got a long way to go in terms of reset. And certainly the same with industrial. Pricing just has not reflected the change in the interest rate environment in those sectors. Office has unquestionably had a reset, and the price that we've paid for these assets certainly is below book value for the vendor that's selling these, which had a 2021 or 2022 valuation, I should say, sorry, and also well below replacement cost. Secondly, contrary to what's happening in other capital cities, the leasing markets for office space in Brisbane is very, very robust. So we're seeing a lot of activity as Ann Street's a good example. We took a building from 48% to 100% occupied in 9 months. There's a lot of the tenant market is very active. Rents are growing. There's pent-up demand in office post-COVID in Southeast Queensland, and that really underpins the office, the persuasion towards buying office at the moment.
And you mentioned Ipswich and Upper Margaret River. Why are Quanta targeting these two markets?
So for all our investments, whether they be in Southeast Queensland or elsewhere, we target markets that have a deep pool of tenants, because at the end of the day, if the occupier risk is a key component of commercial property investment. So we want markets where there are a lot of tenants. We want markets where the number of tenants are growing, and we want to invest in markets where supply is constrained. And for different reasons, both of these assets fit that market well. There's very limited competing vacancy in both markets. They're both very tightly held, well-leased markets. The tenants in there's more tenants that want to get into, particularly Mount Gravatt, than there are opportunities for high-quality office accommodation like what we like the office buildings we're buying. And thirdly, supply is very heavily constrained. Currently, with the current developer market, there's low ability for competition to be built in these areas.
Well, thank you, Chris. Good to see you today, and take care.
Thank you.
Our next speaker is from our ETF perspectives. The head of distribution of Global X, Mr. Kanish Chugh, just joined the call. Global X ETFs was founded in 2008 to empower investors with unexplored and intelligent solutions with more than 90 ETF strategies and over $41 billion in assets under management. Global X is a member of Mirae Asset Financial Group, a global leader in financial services with more than $620 billion in assets under management. Kanish's presentation topic today is the next big theme: how major global thematics will shape our future and drive opportunities for ETF investors. Welcome, Kanish.
No, thank you so much for having me. I'd like to kick off the presentation now and just talk around thematic investing and paradigm shifts. Before I continue, obviously I'd like to show our disclaimer, and any information provided today is general in nature. Please speak to a financial professional and also read through the product disclosure statements and TMDs that are available on our website, www.globalxetfs.com.au. Now, as was just recently stated, Global X is a leading powerhouse within the thematic solutions within the ETF space. We have over $75 billion of assets under management. So what that means is we're managing over $75 billion worth of clients' money within our broad range of ETFs across actually what is now 150 ETFs. And what's interestingly from a Global X standpoint, we are present in majority of developed markets, whether it be across Asia, Europe, Latin America, North America, and now obviously Australia. Global X has really entered into the ETF market, offering investors some very unique solutions. And when we think about thematic investing, that's really what today's presentation is all about. Thematic investing, for a lot of investors over the past 3 to 4 years, they've looked to tap into different themes. But what does that mean? Essentially, what we look at from Global X, and we are very strong in how we approach our product development when we're launching new thematic ETFs and ensuring that investors have the appropriate themes to invest in. We want to identify from a top-down perspective those powerful macro level trends. We want to look, and then from a bottom-up perspective, indexes, so equity indexes, equity benchmarks that can highlight companies that stand to benefit from those particular trends. So it's one side to actually identify what are the macro level trends that are going to disrupt and going to help move our communities forward. They have to be long term. They have to be a focus on growth. We have to think about them as being unconstrained. We can't think of these thematic ETFs as being constrained by a geographic area or a sector. And also that concentrated portfolios often have biases, whether it be towards certain countries, certain sectors, or certain factor tilts. And the final thing with themes is they have to be somewhat relatable. And I'd probably add one more thing here is you have to ensure that when you're looking at themes, when you're thinking about thematic investing, you want to ensure that that macro level disruptive trend has government support. And I talk about that really from this perspective as to what you should think about when choosing a theme. So when we think about taking a step back, you've got your portfolio, you're thinking about how do you allocate to different themes within that. And I think thematic investing and thematic ETFs have seen a lot of growth. We've seen a lot of new thematic ETFs that have been launched in recent years. So if we take a step back, we have to think about, does this particular theme that you're looking at have conviction? Does it have a multi-year time frame? So what do I mean by conviction? Do we perceive that this particular mega trend will have structural changes, whether it be in the demographics of a particular nation or region or globally? Will it be disruptive and structurally change technology, behavior, and also politics and regulation? So an example I'm going to put out there is electric vehicles. And we'll talk a bit more about electric vehicles in another few slides, but we've seen really strong policy shifts to supporting the electric vehicle adoption. You have to ensure that's investable. And I think this is really important because when we look at product development, we are one of the leaders of thematic ETFs, not only in Australia, but around the world. When we consider what types of thematic ETFs we're wanting to launch and support, we have to ensure that there are enough companies that we can invest in that are pure play, that really are linked to that particular theme. And there's some really interesting examples of different themes that have been launched in recent years. And a good example was a clean technology thematic. Now, there was a provider, a very big US provider that had a clean technology ETF. They launched a clean technology thematic product. And that particular product invested in a broad range of companies around the world, some very small companies. It didn't have certain rules in place to limit how much they owned of one company. And what happened there was when you had a big flow of new investors coming into that particular ETF, which occurred with a big institutional investor, all of a sudden it moved the market for some of those smaller companies that were linked into that portfolio. So that's really important. We have to ensure that there is a investable universe that we can invest in, and we have to ensure that there is certain rules in place so we don't own too much of some of these smaller companies which may be linked to some of the more nascent themes. And finally, I talked about it being multi-year time frame. When investing in thematics, you have to take a long-term view. And I say that purely because when we look at our next slide, and this is our famous S-curve. And what this is showing is that when you think about thematic investing, it follows this structural curve. It's not cyclical. It's not going up and down in peaks and troughs. It's following the structural S-curve. So what we're looking at is, you can see there, a lot of the themes that we talk about or that investors talk about are really in that early stage, whether it be the innovator or early adopter. Now, this particular S-curve, the time frame from a theme that goes from innovator all the way to a laggard, can be relatively quick. I think it's quicker than what we might say, the adoption of automobiles over multi-decades. It's still going to be years though. And so that's why we talk about, when we're thinking about mega trends, when we're thinking about thematics, we at Global are very much focused on multi-year themes. And what's interesting is you think about some of these thematics, think something like social media versus the metaverse. So a company like Meta or Facebook, for example, very much a leader in social media. Over the past 10 to 15 years, they've gone from being an innovator of social media, and that the particular thematic has moved into that late majority. But the company of Facebook has had to reinvent itself. It's had to constantly look at how it can re-engineer and look at how it can continually disrupt. And for Meta at the moment, it's looking at areas of AI, but also looking at areas of thematics such as metaverse. So it's bringing itself back forward into this S-curve at the innovator stage as well. Now, a lot of investors would like to be invested in particular themes when they're at that early stage, whether it's at innovator or early adopter. All I would say is the earlier the thematic is in terms of that S-curve, so at that sort of innovator stage, the higher the risk is, but potentially the higher the return is. So more volatility can be associated with those themes. So that's something to be considerate of when investing in particular thematic ETFs. The two particular themes I'm really going to focus on today is around decarbonisation and looking at green metals in particular. And I think it's very, we all know it. Decarbonisation, it's one of the most pressing globally shared objectives of the 21st century across countries, companies, and investors and consumers around the world. We know that with natural disasters, with climate change really forcing an impact and change in weathers, we're seeing an impact. We think about the human impact in terms of lives lost, buildings being, cities being affected, so infrastructure, but then we think about the cost as well. And what we can show you here is that there's an accelerating cost and frequency in the US, for example, of climate disasters. Now, what this actually means is you look at Australian bushfires, for example, the total cost to government, to corporates, to consumers, to residents was over $157 billion. And that was those bushfires that occurred in 2019, 2020. So really, there is an actual monetary impact that we're seeing from climate change as well. And when we think about how do we move forward, I think we need to be conscious of the fact that if we want to adopt clean technologies, so whether it be electric vehicles, nuclear, hydro, wind, solar, hydrogen, whatever it may be, you're going to need minerals, you're going to need resources. And this is a really interesting table just showing you from the IEA. Now, this is as at May 2021, but it just shows you the different types of metals or minerals that are going to be required with the different types of clean technology. So for example, within solar, you're going to need a lot of copper and a lot of aluminium. you're going to need less of, say, cobalt, nickel, lithium. But then you look at wind, nickel is a moderate inclusion, as is rare earth metals as well. And to take that a step further, we can see here in clean technologies, what is the required minerals that are going to be needed. And you can see there in offshore wind, for example, just copper alone is a main mineral or resource required. And that's probably one of the reasons why we've seen a lot of uptake, a lot of price movement in some of these underlying minerals and resources, as we've seen this shift towards clean technology policies, both by the government and corporate level. And just to focus on this a little bit more, what we're actually talking about in terms of those disruptive materials is that lithium demand, for example, could be anywhere from 13 to 42 times higher than 2020 levels. So what you're looking at here is the estimated disruptive materials growth by 2040. So this is a range that you can see. So for example, with graphite or cobalt, between 6 to 21 times, or graphite between 8 to 25 times what its 2020 levels are. And again, this is off the back of clean technologies being developed, bought and introduced into society. What's required to help fund that and fuel that? And finally, just on copper and the supply and demand, this is just important to note that we've seen a lot of talk in the markets recently because of some merger and acquisition. So with copper's demand only going to increase, we've seen companies like BHP really enter and be quite aggressive in the space around M&A, and even, for example, within tech and Anglo-American mines as well. So we know this from a perspective of an ETF that we have, Wire, which focuses on the copper miners, and we've seen a lot of interest just to try and capture, if they can't get access to Australian copper miners companies, how do they access that? And thematic ETFs such as those really benefit investors within their portfolios. And in terms of that renewable, we've talked about this shift. I think it's only going to continue further. It is not just one particular clean technology that will prosper. It is a combination. Electric vehicles are very good use in cars, in small transportation, but hydrogen, for example, potentially has an ability to really benefit industrial use and also large-scale commercial transportation as well, such as ships. Now, the other theme I wanted to talk about, so we've talked about decarbonisation, and I'll touch on some of the funds that we have, but AI. I think we can all say that we use some form of artificial intelligence in our life currently. We may not use it to the full extent that we have the ability to, such as ChatGPT, but whether you use Google, Amazon, Alexa, for example, or Siri within your Apple iPhone, you're using some form of AI. And AI is actually not a new technology. It's all the way back from the Turing test in 1950. There has been AI technology that's been developed. And you think about OpenAI, well, that was actually first launched in 2015. And it's taken 7 to 8 years to get to this point where we have ChatGPT and the impact that it's having, and obviously the use that it's having from consumers, but Siri, for example, in 2011. And when you think about what does that actually mean? Well, from a revenue perspective, we can see there on the chart on the left, just the estimated revenue that OpenAI potentially has to access. Now, what Microsoft is currently doing is it's trying to use OpenAI and ChatGPT as a software as a service-based model. So it's trying to incorporate it within its Bing search engine, obviously trying to counter the competition and trying to be a bigger player in that search engine space against Google. And just today, by the way, it announced that as a licensing fee of $30 per month, you can access and incorporate ChatGPT within your Microsoft 365 service or license. So again, it's trying to access and using some of these AI technologies within a traditional revenue-based model that we currently see across all technology companies. We can also see there that AI as a service spending is only going to increase as technology increases. And in terms of impact, so how does an investor access the AI theme? It can do that through chip manufacturers such as GPU-based AI acceleration hardware. So companies like NVIDIA, for example, or TSMC, Taiwan Semiconductors. And we can see there that NVIDIA's supplied hyperscalers with over 15 billion in chipsets for 2022. So its data center revenue has yet to actually hit its book. So we're actually going to see some really big numbers come with NVIDIA over the next year or two. And then finally, I just want to highlight this one particular area is there are big companies associated with some of these themes. So we can sometimes get bogged down in trying to identify small companies, but there are two ways to play different thematics. And I think when we think about decarbonisation, these are some of the thematics ETFs that we have listed here on the Australian Stock Exchange. So company ETFs like WIRE focusing on copper miners, or ACDC focusing on battery tech and lithium. And this is just a quick slide. ACDC looks at the value chain of the battery tech thematic. And when we think about AI, you're thinking about whether it's multi-thematic. So FANG ETF, and that looks at 10 stocks such as Microsoft, Apple, Amazon, Google, Facebook, Tesla. It's really looking at different themes, AI being one of the biggest focuses for a lot of those companies. Or you can go a bit deeper and you can focus on something like a robotics ETF. So our Robo ETF really looks at automation, robotics, and AI as a specific theme. So 80 companies from around the world. Or as I talked about, tapping into the semiconductor thematic. So AI's technology obviously is only going to continue to grow, but it's going to have a benefit for semiconductor companies, as does a lot of different technological advancements. And we have an ETF called Semi, really just focusing on that particular thematic as well. So that's a really short, sharp sort of overview around Global X and our focus on thematic ETFs and thematic investing.
Thank you, Kanish. Great presentation. Just in the interest of time, we have time for one question. We noticed Global X's 3 AI-focused ETFs have all been great performance in recent months. Is there any crossover between these 3 ETFs? And if you had to pick one of these tech ETFs to own longer term, which one would it be?
Look, the crossover is minimal. So the crossover between Robo and Semi is very minimal. So Robo, as I said, is focusing on companies like Fanuc, who does industrial automation, or John Deere, a tractor company that is very much focused on artificial intelligence and autonomous vehicles within the agricultural space. So you don't have much crossover between Robo and Semi. There is a crossover between FANG and Semi in companies like NVIDIA or AMD. Now, that is understandable. So FANG is focusing on your top 10 large mega cap US listed companies around innovation and technology and media communication disruption. So as I talked about, some of those companies there. What I would say is for the type of investor, FANG is traditionally can be a core building block. It's a very growth orientated portfolio. It's 10 stocks, so it's concentrated. So that's something to be aware of. It's had some very strong returns this year off the back of some of that strong returns in some of those mega cap names. It's nearly 70% plus year to date as at 30th June in terms of its performance. But as a result of being so concentrated, it can also have some implied higher volatility. So something to be aware of. It's more for the growth orientated investors. And for something like Semi or Robo, that's also as a satellite. It's a complement to some of your core building blocks to really highlight and focus on one of these particular themes, which, as I said, they're multi-year megatrends. So it's conscious to make sure that you take that into consideration, that long-term investment horizon.
Thank you, Kanish. Great to see you. Have a good night. Our last speaker tonight is Mr. Blair Kirkhope, head of Sequoia Specialist Investments. Sequoia Commodities Series 18 is a structured product that provides investors with 100% leverage exposure to a diversified basket of commodities on a limited recourse basis for 18 months. It provides investors exposure to the commodities asset class, but without having to outlay significant amount of capital. Blair has over 22 years of financial markets experience and has been running SSI, one of Australia's leading issuers of structured products and a wholly owned subsidiary of Sequoia Financial Group. Prior to that, Blair worked in BNP Paribas, ABN AMRO, and PwC. Blair's topic tonight is why consider investing into commodity markets. Welcome, Blair.
Thank you. Thanks very much for the opportunity to be able to present our current offering. So today what we wanted to do was really talk about why we think commodities as an asset class is an interesting investment for investors to consider. So, but before starting, just a quick disclaimer. So any information provided here is on a general advice basis only and does not take into account anyone's personal circumstances. So who are we? So Sequoia Specialist Investments, we've been in the market for over 10 years. We've issued over 125 investments, totaling a notional currently outstanding of approximately 400 million. Our main objective here is to be able to offer investments to the Australian market that our clients or investors are finding difficult to get access to through traditional wrap platforms or through the ASX. And if we look just quickly on the commodities asset class, there's actually no listed ETF providing one investment providing diversified exposure to the commodities asset class as a whole. You can get exposure to gold or oil, but there's nothing in Australia on the market, on the ASX or CBO, providing investors a diversified commodity exposure through one investment. And that's part of the reason why we're offering this today. So a little bit about why should you listen to SSI or Sequoia. What we do is we collate and consolidate research across a panel of investment banks, including Goldman Sachs, Barclays, Citigroup, and BNP Paribas. But in conjunction with that, we use the investment banks for fundamental research. But in addition to that, we rely on a firm renowned as Armstrong Economics. They built the world's leading artificial intelligence system over 40 years. It's very much focused on timing and on cycles, and has a very prominent position in the market. Just to give a bit of an idea, they ran a conference, Martin Armstrong ran a conference the end of last year with 250,000 virtual attendees at $3,000 a head. His speaking fee for that conference was $750 million. So this firm carries a lot of clout, and we combine it with the investment banking research in order to formulate our view on the market. And that's why that's the basis of our offering today. So yeah, what we try and do is offer new diversification opportunities for investors, which they can't otherwise access through the ASX. So what is our current view on the global markets today? So as a result of the big pickup in inflation and interest rates, we've seen government debt securities, for example, 30-year treasuries in the US or 10-year treasuries, or even Australian government bonds really come under massive pressure from a price point of view. So that particular market, although it's traditionally been viewed as a risk-free asset, we think it's actually carrying the highest risk of any asset class at the moment. So we look at long-term government debt as being currently in a bearish trend. We think global equity markets are currently in a bullish market. We think, notwithstanding all the headwinds fundamentally in terms of interest rates and inflation, if you look at the S&P 500 or even the Dow Jones Industrials Average, that's only 10% from all-time highs, which is quite phenomenal. And we're seeing basically there's a big shift in capital away from the government bond sector into equities. And so, those are the two prevailing underlying trends. But there's a question mark about commodities. Whilst a lot of investors might get exposure to particular commodities through their equity portfolio, it does carry certain risks associated with it. And we think that with the high inflationary environment, the commodities asset class is likely to continue its existing bullish trend for many years to go, for many years to come. So let's talk a little bit more about that. This is just a chart on the 30-year Treasury. So government bonds, 30 years, you can see towards the right-hand side, that's a big collapse. It's a big technical breakdown that's showing you that the bond market is bearish. This is the US Dow Jones Industrials Average, just showing you long-term, very bullish market structure from that perspective. But then the question is, okay, what about commodities? This is a long-term chart here, going all the way back to 2006. You can see the peak on the left-hand side around 2007, 2008. That was the last peak. But since the 2020 lows, the commodity market has just started to turn the other way. And we think this is just the beginning of a bull market in commodities. It reached a high on the right-hand side. It reached a high basically in 2022 when the war started. When Russia invaded Ukraine, it's pulled back for approximately 12 months 12 or 13 months, and we think it's presenting an excellent opportunity or entry point opportunity right now for investors. And let's talk a little bit about that. Why is that? This is an unusual looking chart. It's an output from the artificial intelligence system called Socrates of Armstrong Economics, and it is suggesting from a cyclical standpoint that inflation should peak in 2026. So what we're looking to do from a commodity standpoint is play that trend, playing the trend of inflation going over the next few years. So what is really driving that? Let's think about it fundamentally. Okay, from a cyclical standpoint, we think inflation will peak 2026. That's based on an artificial intelligence system forecast from a timing standpoint. But fundamentally, what's driving this? So we know, obviously, it all started with the COVID lockdown, supply chain disruptions. A lot of those actually have not been fully addressed, have not been fully fixed. So there are still a number of essential materials that are stuck in supply chain. But I would say the most overriding and most important driver of inflation right now is the war in Ukraine. Historical international war has always been the most important factor driving inflation, and that situation is far from getting resolved and is likely, in our view, to continue for many years to come. In addition to that, we have obviously, the climate change policies. There's a lot of divestment away from fossil fuels. We have increasing protectionism and also cuts coming from OPEC, etc. So there are a lot of fundamental factors at play which are driving this going forward. We look fundamentally again in terms of our fossil fuels. We really like what's happening with clean energy, but we have to be realistic about the fact that fossil fuels is by far and large the major energy source driving the global economy currently, and it's going to take a long time for that transition to occur. So we think it's important to take note of that, especially during a high inflation environment. When we look at what is the Goldman's forecast, so the Goldman Sachs, we rely on their fundamental forecast. They're very bullish over the next 12 months, especially in relation to the energy sector and the precious sector, the precious metal sector. So they're looking at 58% rally in the energy sector and almost a 25% rally in industrial metals over the next 12 months. Looking at why is that from their perspective, they think that we've got some a supply-demand imbalance in terms of energy over the next 3 to 6 months during 2023. So that's on the right-hand side. Deficits are expected across oil. The same is picking up in terms of the same is occurring in copper. So deficits expected in copper over the next few years. And in natural gas, we can see they're expecting some price uplift in terms of natural gas prices going forward. That is the yellow line there compared to the dotted line, which is the current price. So they think a pickup in natural gas prices. So these are just a few slides showing fundamentally that why they're bullish in this sector. And so this is the reason we think from a cyclical standpoint, commodities are showing an excellent entry point in terms of the pullback over the last 12 months. Fundamentally looking forward, a lot of the banks are very bullish. And so we think it's a right time right now to consider making an allocation into commodities. And that's why we've launched Sequoia Commodities Series 18. So let's talk a little bit about the terms of this investment. So this is a structured product where the terms and conditions are fixed up front in the terms of the product. So it runs for 18 months. What we do is we lend investors 100% of the investment amount. So there's no initial margin. We lend 100% of the investment amount on a limited recourse basis. So what that means is if the investment goes down by maturity, you simply walk away from the loan. We are not required to, or there's no recourse that we have back to you in the event that occurs. So we lend 100% on a limited recourse basis at only 5.9%. So when you look at the current mortgage rate, it's a full recourse mortgage. You're at risk if you can't repay the loan and the property falls. That's not the case here, but our interest rate is pretty similar. So we think it's very attractive funding rate for something that is 100% lending and limited recourse combined. We charge a 1.1% application fee. So in total, when you say 1.5 years times 5.9% plus 1.1%, the total investment cost is 9.95%. So if we think of an example, $100,000 loan, if you wanted $100,000 of exposure to the commodities asset class, it would cost you $9,950. And that is your absolute worst case risk. In the worst case scenario, that's what you can lose. You do get a tax deduction for your interest, which is spread over the term of the loan. So that can also reduce the potential worst case after tax risk, especially if you're in the top marginal rate. And then at maturity, what we do is we measure the performance of the underlying commodities index, and we pay that through in the form of a performance coupon at maturity, and we calculate that by reference to the $100,000 investment amount. So if the index is up, say, 10%, you would break even. We'd be paying a coupon of $10,000. You would recoup your original investment cost. If it's up 20%, you would be basically doubling your money at the end of the 18-month period. We offer daily liquidity so investors can exit at any point in time. So there's absolutely no lock-in. You can take profits off the table early before maturity if you like to do so. So they're a quick summary of the terms. Examples of investment costs. So $100,000 investment amount would cost $9,950. $500,000 of exposure would cost $49,750, or $1 million of exposure to the commodities asset class would cost you $99,500. So what is included within the underlying commodities index? There are 13 commodities in total, including cash across industrial metals, copper, zinc, aluminium, nickel, lead. It includes gold and silver, WTI crude. So many of the benchmark commodities within the energy sector, especially including WTI and Brent crude oil, natural gas, diesel, gasoline, and low sulfur gas oil. These are the benchmark commodities included for the energy sector. So when we look at the actual performance of this index itself, this is published by BNP Paribas. So when we look at, since the 2020 low up into April, May last year, there was a 67% rally from the trough to the peak, and it's pulled back since then at approximately 13%. So we think this is still indicative of a strong bullish market, a slight pullback, and we think the entry point right now cyclically is very attractive for investors to take advantage of that pullback. The reason we say that, oil has pulled back from 130 or 140 back to 70 or 75 right now. When you look at natural gas, it's pulled back from $10 back to about $2.50. It's a huge pullback and a lot of upside in terms of natural gas. And when we look at the gold, we think we're on the verge of breaking out at 2,100 in terms of gold. We've had a pullback into June, and we think this is about to break out during Q3, potential Q4. So positioned quite nicely for gold as well. So that's it for me. Just a quick summary. This is a high risk investment with the potential to generate a higher return. Investors can lose 100% of their initial cash outlay, but can never lose more than that. So then they have no risk in relation to the loan amount. And if investors this is open to both retail and wholesale investors. If you are a retail investor, we have to ensure that you fall within the target market. And Hamish McCarthy at Sequoia Wealth Management is the advisor here, and will take any inquiries for investors. His details are shown here. This investment closes on the 8th of September. So there's a bit of time left to consider. And we'll start on the 15th of September. So that's it for me.
Thanks, Blair. I've got some questions for you. Can you explain the limited recourse loan again, please?
So yeah, that's a very good question. So as I mentioned, we lend 100% of the investment amount. So if we talk about that example where an investor wanted $100,000 of investment exposure to the commodities market, we will lend $100,000 to the client on a limited recourse basis. But however, if that commodities basket or commodities underlying actually falls by the maturity date 50%, so in a normal full recourse loan, an investor would be required to repay that difference on the loan of $50,000. However, in this particular case, that's not required. There's absolutely no recourse that we have back to the client in relation to that, and investors would simply walk away. And the reason for that is because we've actually built into the interest rate effectively a cost of protection on that portfolio. So the underlying hedge provider here takes the risk in relation to that loan amount. So that's why it's limited recourse.
Sorry, so you lend investors 100% of the investment amount, but the investors don't have to repay these if the underlying index falls.
Absolutely.
Have I understood this correctly? What's the catch?
That's absolutely the case. So yeah, we lend 100%, and if it goes down, investors do not have to repay all the loans. So they take no risk in relation to the loan, and they get all the upside in relation to the leveraged investment exposure. However, they are, of course, there's no magic involved here. So, of course, they are at risk in relation to their initial cash outlays. So if it costs them $9,950, that's an interest cost plus the cost of the application fee. So if the index does fall, they do not get their $9,950 back. So they are at risk in relation to the $9,950. And in order for investors to break even, the index has to be up 10% at maturity in order for clients to actually receive a performance coupon of $10,000. If that occurs, then they have broken even. So anything above that, so if the commodity index performance at maturity is above 10%, that is when investors start generating a net profit from this investment.
Right. And is the prepaid interest tax deductible?
Good question again. Yes, it is tax deductible, fully tax deductible. The reason for that is because it is incurred for the purpose of generating assessable income. So the performance coupon at maturity that investors hope to achieve if the index is positive at maturity is actually assessable income for investors. Because that's the case, and the expectation is that performance coupon should be greater than the interest cost that's incurred, then it is actually tax deductible. However, it's not deductible at the time of payment. It is something that is accrued and amortized over the term of the loan. So what that means is that clients would effectively be claiming 9.5 months worth of interest during the tax year ending 30 June 2024, and then the balance of the prepaid interest would be claimed in the tax year ending 30 June 2025.
Right, that makes sense. Well, thank you, Blair. Good to see you, and have a good night.
Great. Thanks very much for the opportunity to present.
This includes the Investment Markets July Investor Webinar. If you're like me, who would like to revisit the presentations and Q&As so you can digest the information that's been shared in the last 3 days. For those registered, you will soon receive a link to access the recording and immerse yourself in the wealth of insight and knowledge shared during this event. If you haven't registered, but you've liked this link, please email events@investmentmarkets.com.au for it to be sent to you. As Australia's independent and most comprehensive platform of investment products, education, including events, we invite you to register to be our platform members for free or sign up to receive our weekly newsletter. As firm believers and enthusiastic facilitators of empowering investors through information and knowledge, we strive to equip you with the tools you need to succeed. Our team and presenters have put a lot of efforts in putting together this event. We hope you get value out of it, and we look forward to bringing you more events soon. Stay tuned, and thank you for your unwavering support and the trust you placed in Investment Markets as your go-to investment platform. Together, let's embark on a journey of financial growth and achievement.